Now we're ready to talk about capital deepening. And the idea is that when you add more capital per worker, what happens is your output per worker, okay, you have labor here and you have output here. So the same amount of labor can produce more output, okay? And so what that means is when you have capital deepening, that's increasing the capital per worker, each worker can produce more. Now, what happens is when each worker can produce more, then there's an increase in demand from this demand curve to this demand curve for labor. And when you have increased demand for labor, wages go up and workers basically make more money. So now, let's summarize this. What capital deepening is that's literally adding more capital per worker. And to give you an example of that, suppose we have a worker and they're producing certain widgets, and if they had an extra machine or extra piece of equipment available, they could actually produce more output per worker with that extra capital. And so if you give them that extra machine, then that same person can produce more output, which is reflected by this curve shifting out, okay? And what that does again is it causes the demand for labor to go up, because if labor can be more productive, then employers are going to demand more labor, and that's going to cause, again, wages to shift up. And this is not just theoretical, this actually happens. In fact, if you go back and look at the U.S., for example, in the 1800s, as we developed more industrial equipment, then what each worker was able to be more productive. Instead of doing things completely manually, now things became more automated, and there was there's more capital for workers to use to be productive. And what happened is that each worker was able to produce more, and then their actual wages went up. So this is a really interesting way to show why, if you increase capital, you have lots of benefits. One, the economy produces more, and two, workers actually enjoy a higher standard of living or a larger income.